Welcome to Finance in 5. Disney has always been a favourite stock pick for long-term investors. Its share price has tanked recently, however, because of COVID-19. So, we find ourselves asking some key questions. Will its theme parks reopen soon? Will its other businesses begin where they left off, generating revenue? And finally and crucially, is this dip in Disney's share price a buying opportunity? Some say that Warren Buffett's biggest mistake was dumping Disney stock twice. The Oracle of Omaha met Walt Disney himself in 1966, at a time when the animators company was valued at $85 million, less than 0.5% of its current market capitalization. Disney had just released Mary Poppins, which netted it $31 million in North American rentals off a $4 million budget. So, Warren Buffett snapped up 5% of Disney back then for $4 million, and he sold the shares a year later for a 55% profit. Not bad. Until we realized that that 5% stake in Disney would now be worth an astounding $12.3 billion. The company is well known for its evergreen content, global brands, and a growing number of worldwide subscribers. However, along with the massive sell-off in the global stock markets, Disney's share price has been beaten down significantly, dropping from $152 to only $108 per share at the time of this recording. So we ask, could Disney now be undervalued? Here are 5 reasons as to why you should consider buying the stock. Number 1. High margins. Disney is a high-margin set of businesses with high liquidity. Disney has multiple revenue generation capabilities. The brand segments into 4 main business arms, including direct-to-consumer and international, studio entertainment and media networks, parks, experiences, and products. The majority of revenue and profits come from 2 segments, media networks and parks, experiences, and products, while the direct-to-consumer segment has been generating losses. All 3 business arms have generated double-digit operating margins. At first glance, investors might worry about Disney's high debt level at $48 billion as of December 2019. However, in the next 2 years, only around $12.3 billion of debt will be due. Frozen 2 and Skywalker helped studio revenue more than double to $3.76 billion. Parks revenue rose 8% to $7.4 billion, despite a decline in Hong Kong due to political unrest. Disney currently has $6.8 billion in cash. Furthermore, it has entered 4 different credit agreements for various amounts of money. Thus, Disney's total liquidity reaches $24 billion, which is more than enough to service its debt in the next 2 years. Managing the effects of COVID-19. Since the middle of March, Disney parks around the world, including Disneyland and Disney World, have been closed. The theme park business accounts for a significant amount of Disney's revenue and profit. In the final quarter of 2019, the business accounted for more than 35% of Disney's total revenue and 58% of its operating profit. So some investors feared that closed parks would weigh heavily on Disney's financial results. The company warned that it could lose $135 million in operating profit at its Shanghai theme park, which is closed. But China has mainly got COVID-19 under control. The country is slowly reopening its businesses. It remains to be seen, however, how quickly Disneyland visitor numbers will rebound. But with social distancing measures still in force, the pickup could be subdued for what remains of 2020. Resuming some operations should help lift some pressure off Disney's stock. Disney has expressed the situation in its recent SEC filing. We have closed our theme parks, suspended our cruises and theatrical shows, delayed theatrical distribution of films both domestically and internationally, and experienced supply chain disruption and ad sales impacts. In addition, there has been a disruption in the creation and availability of content we rely on for our various distribution paths, including most significantly the cancellation of certain sports events and the shutting down of production of most film and television content. As a consequence, Disney's overall businesses would be hit quite hard. Analyst MoffettNathanson estimated that Disney parks might lose around $3.4 billion in revenue this year due to park closures. If we assume parks segment revenue in 2020 is $3.4 billion lower than it was in 2019, then its parks, experiences, and products 2020 sales would be $22.8 billion. Applying a 25.8% operating margin, this segment would produce around a $5.9 billion operating profit, which is still reasonably significant. The coronavirus has hit the Walt Disney Company hard, particularly in shutting its theme parks and experiences, which raked in more than $26 billion in sales last year, as well as putting its movie productions on pause, including the postponement of the big-budget release remake of Mulan from March until late July, and sliding feature films like Frozen 2 and Onward onto its Disney Plus streaming service months earlier than planned originally. The studio entertainment business, which generated more than $11 billion in 2019, is also impacted negatively due to the shutting down of film and production activities. The film releases, including New Mutants, Antlers, Black Widow, and The Personal History of David Copperfield, are all postponed. The delay would significantly hammer Disney's April to June revenue generation from film releases. If we assume that the lockdown causes a 10% drop from 2019 revenue, Disney's 2020 studio entertainment revenue would come in at around $10 billion. Applying a 24% operating margin, as discussed previously, this segment would bring in around $2.4 billion in operating profit. As the virus pandemic significantly restricts travel and leisure activities, it would also have a negative impact on Disney's advertising revenue. Bernstein research media analysts commented that Disney could lose between 3 and 8% of advertising revenue from the second quarter this year. Assuming the media network's revenue came in at 3% lower than 2019, its media network's revenue would be $24 billion and the operating profit would be $7.23 billion. 3. Lots of Disney Plus subscribers. The most promising segment in this environment is Disney Plus, the commercial-free home streaming service in the Americas and Europe. Recently, the company announced that it has achieved more than 50 million paid subscribers globally. The service finished 2019 with 26.5 million subscribers, which rose to 28.6 million as of February the 3rd. So this huge rate of growth is attractive for shareholders. However, the company will need to reach at least 90 million subscribers in order to break even, since it allocated so much capital for the development of the Disney Plus platform initially. In October 2017, Morgan Stanley had expected Disney's streaming service could have 30 million subscribers by 2028, with a $25 billion valuation. Disney has significantly outperformed that expectation with the recent subscribers information. With the current growth, Disney Plus could easily grow its subscribers to 75 million. Netflix, the streaming service competitor, has around 167 million subscribers and 1 billion hours watched per week. With the current total market capitalization of $193 billion, each Netflix subscriber is valued at around $1,155. As Disney Plus content is not as diverse as Netflix, and because Netflix's share price has significantly surged to the record high recently, we conservatively could estimate that the subscriber value would be around 2/3 of Netflix's at most, which would be at around $770 per subscriber. Therefore, with 75 million subscribers, Disney Plus would be valued at around $57.75 billion. Wells Fargo analyst Stephen Cahill said on February the 19th that he expects Disney Plus to draw 6 million subscribers in India this year, and he estimates that chief rival Netflix currently serves 4 million in India. Cahill maintained his view that there would be a $180 price target. Number 4, healthy underlying business model.
I would rather start with Disney's hand than anyone else's by some margin.
Just because people aren't attending theme parks due to government rules, that does not nullify the profitability of this arm of the business. We won't be banned from going outside forever, and there's likely to be significant rebound in sales numbers even if not immediately. Days out have been impossible due to the lockdown, and there are many families whose holiday destination of choice is Disneyland. With all this pent-up demand, whether the lockdown ends in a month or 10, those eager families will embark upon trips to the resort almost as an act of defiance to demonstrate that they will not be denied their customary annual leisure retreat. Florida's Walt Disney World has 4 major theme parks: the Magic Kingdom, Epcot, Disney's Hollywood Studios, and Disney's Animal Kingdom. The Financial Times report originally claimed that Disney was still paying dividends to shareholders while no longer paying workers, but the story later clarified that the Disney board has yet to declare a dividend for 2020. Disney had been paying out twice yearly to shareholders. That's how good the company was. Consistent payout of dividends on an ongoing basis twice yearly. There aren't many companies that offer those sorts of returns. Number 5, strong track record. Disney has been a double-digit compounder for nearly 75 years. Could anybody have predicted in the late 1950s and throughout the 60s that this would occur? Disney's myriad of businesses could benefit as pent-up demand translates into increased revenue once restrictions are lifted. Think about it. It's not just a reopening of the company's theme parks that could move the needle here. The company's ESPN unit has suffered greatly from sports being put on hold. What about movies? No one's going to cinemas at the moment, but when they reopen, box office receipts could see a boost as well. So in short, as a result of going through all of those different thoughts and statistics and all of that information, buying Disney right now perhaps could give you the exposure to multiple affected industries returning to normal.
If I thought the children of the world were going to want to be entertained 10 or 20 years from now, and I had my choice of betting on who is going to have a special place, if anyone has a special place in the minds of those kids and their parents, I think I would probably rather bet on Disney.
The tailwind that the streaming business would receive if social distancing continues probably softens the blow with regards to shares falling back to past lows because people can't go to the parks and spend money there. So in other words, a great risk or return proposition. If Disney can't sell at its parks, it can sell Disney Plus, which it is doing. But this isn't the only reason to consider Disney stock. What are your thoughts? Is this a great investment or isn't it? Let me know in the comments below. Will you be investing in Disney, or have I got this completely wrong? Is it just going to tank still further into 2021? What shares do you think are even more attractive than Disney right now? Let me know in the comments below, and thanks for watching. That wraps things up for today. If you enjoyed this content, please feel free to like and subscribe, and I will see you all soon.